So our topic for today is loans receivable or loans or accounting for loans. Okay, so we start first by defining what is a loans receivable. So a loan receivable is a contractual right to receive cash, evidenced by a contract of loan. Okay, so we can recognize a loan receivable generally because of the contract of loan. Normally, loans receivable arises on your banks, financial institutions, or financial intermediaries. Okay, so we recognize loans receivable on these different entities: banks, financial institutions, financial intermediaries. Why? Because they have the means. They have the means, so they can lend enough money to others through a contract of loan. So not everyone or not all businesses can provide a contract of loan. So you cannot just provide a loans receivable. So only those who has enough capital that can really give or lend enough money. So these are your banks, financial institutions, and financial intermediaries. So a loan receivable is still a financial asset. A loan receivable is still a financial asset. It being a financial asset should be measured under PFRS 9. Okay, so again, what are the items that we need to learn in a loan receivable? First, of course, is the measurement and recognition. Next, we need to learn the presentation of your loan receivable. So we start first with your recognition. Okay, so when do we recognize a loan receivable under our books? So normally, that is when there is already an agreement regarding your contract of loan under your actual practice. But per accounting, when do we recognize it? We recognize it based on your recognition principle or your broad recognition principle under your conceptual framework. And that is when the transaction is relevant and it can be faithfully represented. So what particular act can we say that the transaction is already relevant? It is relevant when there is already a signing of contract of loan, and the entity will now grant the contract of loan. And how can we say it is faithfully represented? Of course, if you can present it in your financial statements as a loan receivable. As a loan receivable. Now, after knowing the recognition, we proceed to the measurement. So under the measurement, we need to know the measurement of your loans receivable both initially and subsequently. So we need to learn the initial measurement and the subsequent measurement of our loans receivable. We start first with your initial measurement. So under your initial measurement, we learned before that a financial asset, which is recognized under PFRS 9, is initially measured at fair value plus transaction cost. So what is this fair value plus transaction cost in the context of your loans receivable? What is this fair value plus transaction cost in the context of your loans receivable? This fair value plus transaction cost in the context of your loans receivable is known as your principal amount plus direct origination cost less direct origination fee. Okay, so what are these direct origination costs and direct origination fees? So direct origination costs are transaction costs incurred by your lender. So these are your different transaction costs incurred by the lender. Okay, so these are your transaction costs incurred by the lender. How about our direct origination fee? Direct origination fee are fees charged from the borrower. Fees charged from the borrower. Okay. So normally this fees charge shall include, of course, a direct charge on the principal amount, can also include for any activities regarding the evaluation, the processing of your loans. So normally, this direct origination fee pertains only regarding the fees due to the approval of the loan. So any fees after the approval of the loan. However, your direct origination costs are costs incurred by the lender before the approval of the loan. So it can include any costs regarding the credit rating of your borrower, investigation regarding the borrower can really pay or not, etc. So those are different direct origination costs. So these are costs incurred by the lender. So this direct origination cost shall be included on the principal amount. Sir, why should we include it? We include your direct origination cost because, again, how do we measure your loans or your financial assets under PFRS 9? That is fair value plus transaction cost. So your transaction cost here is your direct origination cost and your direct origination fee. However, guys, since we have fees that we charge to the borrower, then we need to decrease our cost. Then we need to decrease our cost. So it's as if it is an initial payment out of our principal amount. Okay, so principal amount plus direct origination cost less direct origination fee will give us our initial carrying amount. So what is the principal amount? The principal amount here is the amount stated under the contract of loan. Contract of loan. So this is the face amount of the loan. This is the face amount of the loan. Okay, so how do we record this particular transaction, especially with a direct origination cost and a direct origination fee? So to record the principal amount, to record the principal amount, we debit loan receivable, we credit cash. Next, to record direct origination cost. To record direct origination cost, we debit unearned interest income, credit cash. Okay, so as you can see, whenever we record direct origination cost, we said it increases your loan receivable. It increases your loan receivable because we add the direct origination cost. Therefore, guys, whenever you have an earned interest income, unearned interest income also increases the carrying amount of a receivable. Unearned interest income increases the carrying amount of the receivable. Okay? If we have your unearned interest income. If we have unearned interest income. Next, how about your origination fees? So to record direct origination fees. So we debit cash, we credit unearned interest income. Unearned interest income. Okay. Therefore, to compute for the carrying amount or the initial carrying amount of the loan, we have here your principal, which is the value of the contract of loan, plus or minus your unearned interest income. Okay, so this is the carrying amount. What is your unearned interest income again? Unearned interest income. What particular element? Is it an asset? Is it a liability? Okay, so unearned interest income is considered as a liability. But if you have a negative unearned interest income, meaning you have a debit to unearned interest income, this increases your loans receivable. But if you have a net balance of unearned interest as credit, that is a deduction to your loans receivable. Again, so the initial measurement is equal to your principal plus or minus your unearned interest income to get for the carrying amount. So your unearned interest income is considered as a liability. It is an element of liability. What's the normal balance of unearned interest income? Credit. If ever the balance is credit as to our unearned interest income, then we have a reduction to your loans receivable. We have a reduction to your loans receivable. If we have a debit to your unearned interest income, then we have an increase on your loans receivable. Okay. Now, we look as to the effect of your difference on your face amount and your carrying amount. Okay. Why is there a difference now on your face amount and carrying amount? This is due to the fact that we need to increase the face amount by the direct origination costs and reduce by the direct origination fees. Why? Because this face amount is known as your principal amount. Now we said on your carrying amount, it is equal to your principal plus direct origination costs less direct origination fees. Therefore, there is now a difference as to your face amount and carrying amount. So your face amount can be greater than your carrying amount, or your face amount can be lesser by your carrying amount. If your face amount is greater than your carrying amount, then we have a discount. Why? You should collect this particular amount. However, for our books, this is the only amount. Then we have a discount. Okay, so we have a lesser amount. So the lesser amount, let's say it should be 5 million, but you can only collect 4.5 million, let's say, per carrying amount. Therefore, you should collect 5 million. You gave a discount of 500,000 because it can only be recorded at 4.5. But if the face amount is lesser than the carrying amount, then we have a premium. So what is this premium? So for example, we have 5 million contract of loan. Per the carrying amount, it is 5.5 million. So you have an extra amount of 500,000. We call that your premium. So what is the effect of this face amount and the difference on your carrying amount as to our stated rate and effective interest rate? So we have here a stated rate and effective interest rate. So what is this stated rate again? This is also known as your nominal rate. This is the rate of interest is stated in the contract of loan. Effective interest rate is known as your market interest rate or market rate or your yield rate. So this is the rate of interest after considering your direct origination cost and direct origination fee. So what happens to your stated rate and effective interest rate in terms of discount? If there is a discount, your stated rate is lesser than your effective interest rate. And your stated rate is greater than your effective interest rate in case of premium. So if there is a discount, stated rate is lesser than your effective interest rate. If there is a premium, stated rate is greater than your effective interest rate. So why is it important to know the relationship between the stated rate and effective interest rate? Guys, since we need to add your direct origination cost, we deduct your direct origination fees. Therefore, we cannot already amortize using the stated rate or the nominal rate. What we need to use now is the effective interest rate. Therefore, guys, you need to determine the relationship for you to properly compute the effective interest rate. For you to properly compute the effective interest rate. Okay? So, again, how to initially measure your loan receivable? It is equal to your principal or the face amount, less direct origination cost, less direct origination fees. By the way, guys, this direct origination cost is normally stated in pesos. It's stated in pesos. While a direct origination fee is stated as a percentage of the face amount. So, for example, 5%, 4%, or at some point, it is known as 5 point. When we say 5 point, it's still 5%. Okay? So, if ever you will meet a problem, 5 point direct origination fee, blah, blah, blah. It means 5% direct origination fee. Okay? So, let's have an example. So, you granted a contract of loan with a face amount of 5 million pesos. Okay? So you granted a contract of loan with face amount of 5 million pesos. You incurred direct origination cost of 159,816.87. And you charge a direct origination fee, which is equal to 8-point origination fee. 8-point origination fee. So we compute for the initial carrying amount. So the initial carrying amount is equal to your face amount, which is the principal, 5 million, plus direct origination cost of 159,816.87, less direct origination fee, which is equal to your 8% of 5 million. So the 8% of 5 million is equal to 400,000. So this will give us 4,759,816.87 as the initial carrying amount. Okay? So that's just how we compute for the initial carrying amount. So what if we have indirect origination cost? Guys, if you have indirect origination cost, it will be treated as an expense. It will be treated as an expense. So what is our journal entry? So you debit the expense, you credit the cash. So that's how we will record your indirect origination cost. Take note, what is only included on our initial carrying amount is the direct origination fee and direct origination cost. So please, if there is an indirect origination fee or indirect origination cost, what is our treatment? If it is an indirect origination cost, we expense. Sir, can there be an indirect origination fee? Generally, no. It will always be direct origination fee because you charge it directly to the borrower. You charge it directly to the borrower. So we're done with our initial measurement. We proceed now to our subsequent measurement. So how do we subsequently measure your loans receivable? Your loans receivable is subsequently measured at amortized cost. So this amortized cost is still included under PFRS 9. But what method of amortizing? So we amortize the discount or the premium based on our effective interest method. Okay, so based on our effective interest method. Okay, so we try to amortize the discount or premium using effective interest method. What is this discount or premium again? This is the difference between the face amount and the carrying amount. So whatever is the difference between the two is known as your discount or your premium. Okay. So we use your effective interest method. But the problem in your subsequent measurement, guys, is we don't know the effective interest rate. The problem is your effective interest rate is unknown or your yield rate is unknown. So how do we determine? How to determine the effective interest rate? So how do we determine the effective interest rate? So to determine the effective interest rate, we use the actual effective interest rate. Actual effective interest rate. Therefore, we need to interpolate to arrive at the effective interest rate or the actual effective interest rate. Why? Because remember, in your financial management, your effective interest rate can be determined into two. So you can use two processes. First, that is your approximated effective interest rate or approximated yield rate. Next, we have your actual yield rate or effective interest rate. So what we use here in financial accounting is the actual yield rate or effective interest rate. Therefore, we use the process of interpolation. So we interpolate to arrive at the actual effective interest rate. So sir, how should we interpolate? So by interpolating, you just get the present value using an effective interest rate. So when or how to determine the proper effective interest rate. So remember, we have here a discount or a premium. What did we say in a discount? What is the relationship of the stated rate to the effective interest rate? If there is a discount, the stated rate is lesser to your effective interest rate. If there is a premium, your stated rate is greater than your effective interest rate. Okay. So what's the use of this? So for example, you already computed the carrying amount and you compare it to your face amount, right? There is a difference. If the face amount is greater than your carrying amount, what did we say? Again, this is a discount. If it's lesser, then we have a premium. After knowing it is a discount, let's say we determine it is a discount. So let's say our example. In our example, our carrying amount is 4,759,816.87. That is our carrying amount. Now our face amount is 5 million. So our face amount is greater than your carrying amount. So we have a discount. So assuming our face amount bears a stated rate of 10%. So assuming our face amount bears a stated rate of 10%. So we said, if there is a discount, your stated rate is lesser than your effective interest rate. Now, since it means that your effective interest rate is greater than your stated rate in a discount, you know that this is the rule already. To interpolate, it means that you must use an interest rate which is now greater than your stated rate. So if our stated rate is 10%, if you interpolate using a trial and error method, then you can use 11% for the first time. If ever using 11%, you will yield this one, then it's okay. You got it now. But if not, then you try another percentage, 12%. You use 12% and you got the carrying amount. Then that is the effective interest rate. So we try to interpolate, we use the proper the interpolation, and we use your trial and error method. So you use, again, the relationship of the discount and premium as the face amount and the carrying amount to your stated rate and effective interest rate. So alam mo ng discount, edi gumamit ka ng mas mataas na effective interest rate. Kung alam mo ng premium, edi gumamit ka ng mas mababang effective interest rate. So for example, discount. So meron tayong discount, guys. Meron tayong discount. Ang stated rate natin ay 12%. So kung discount yan, kailangan pagka nag-interpolate ka, ang trial and error mo, mag-start ka at 13. Next, 14. 15, ganun. O kaya pwedeng 13.5, 14.5, 15.5 hanggang makuha mo If there is a premium naman, let's say your stated rate is 12%, syempre, ang gagamitin mo for your effective interest rate is lower. So you can start at 11, and then you go with 10, and then you go with 9, until you get the carrying amount. Okay? So you use your trial and error method. Sir, how do we use your trial and error? How do we compute for the carrying amount? So based on your current percentage, so let's say your current percentage, ang gagamitin mo ay 13. Okay? So ang gagamitin mo ay 13%. So using your current percentage, you compute for the present value of your carrying amount or your principal using your current effective interest rate, if that is 13 or 11 or 10 or 14 or 9 or 15 whatsoever, you use that to compute for the PV of principal, and you use that to compute for the PV of interest. Then we will get for the total present value. Then this total present value based on your trial and error must equal the carrying amount, must equal the carrying amount. Okay, so let's use our example. Our example has a carrying amount of 4,759,816.87. And our face amount is equal to your 5 million with a stated rate of 10%. So we know it is a discount. We know it is a discount. Therefore, our effective interest rate must be greater than 10%, must be greater than 10%. So we try 11%. We try 11%. So we compute for the PV of principal and PV of interest. Okay, so syempre, to compute for our PV, we need a period. So let's say our period is 3. Our period is 3. Okay, so we try 11%. So we'll just compute for the PV of principal first. Okay, so we will get here 3655,956.91. Then we get for the PV of interest 1.11. So we have 1,221,857.36. It's 3655,956.91. Okay, so this is 4,877,814.27. Therefore, 11% is not the rate. We try 12%. We try 12%. So let's compute for PV of principal and then PV of interest. Okay, so PV of principal first using 12%. Okay, wait. 3,558,901.24. 1,200,915.63. So plus 3,558,901.24. Okay, so we will get 4,759,816.87. Therefore, our effective interest rate now is 12%. So after knowing your effective interest rate, we can now prepare your amortization table using your effective interest rate, of course, under your effective interest method. Okay, so we already learned what is your amortization table under your notes receivable. Okay, so you just prepare amortization table until you get for the final carrying amount, which is 5 million, Okay, so initial measurement, we have your face amount or your principal plus your direct origination cost less direct origination fee. Subsequent measurement using your amortized cost effective interest method. Now, how about our presentation? So how do we present it? How do we present it? Whether it is current or non-current. Okay. So if that is a loan receivable with principal repayment, so let's see if there is a principal repayment. So with principal repayment. So what do we mean by with principal repayment? So let's say every year you will collect something that is with principal repayment. Or if it is a lump sum. Okay, so what is the current portion? The current portion with principal repayment is equal to the amortization for the next period. Amortization for the next period. If that is lump sum, what is the current? No current asset. It will only become current if it is collectible within 1 year. Okay, how about for non-current? If that is a principal repayment, that is the carrying amount for the next period. If that is a lump sum, of course, the carrying amount, the total carrying amount is equal to your non-current portion. Okay? So if it's with principal repayment or with lump sum. No problem with lump sum kasi alam natin na saka lang naman magiging current yan pagka makokolekta na talaga natin yan. So if that is a 3-year, magiging current lang siya on the second year. So end of second year. Okay? So non-current talaga siya, magiging current lang siya end of second year because it is now collectible within 1 year. Ang problema mo pagka with principal repayment. So, paano ba natin siya kukunin yung presentation? So, pagka current and non-current ang tanong sa presentation ng loans receivable. So, for example, we have here your interest received, interest income, principal repayment, then we have your amortization, and then your carrying amount. So we have your year 1, so X, X, X. And then year 2, we have your X, 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 X. Okay, so if we say the current, if the current under your with principal repayment is the amortization for the next period. So if today is year 1, so this is today, end of year 1. What is the current? The current is the amortization of the next period. So this is the current. The non-current is the carrying amount for the next period. So the carrying amount for the next period is this one. So this is the non-current. Okay? So let's say this is the carrying amount at the end of year 1, right? So today at end of year 1. When can we say that this portion is the current? When can we say that this portion is the non-current? So the current will be the amortization for the next period, and the non-current is the carrying amount for the next period. And the non-current is the carrying amount for the next period. Okay? So that's it for our loans receivable. We learned again regarding the recognition, the presentation, and measurement of an item in our financial statement, particularly loans receivable. Okay?